Yoav Sharon joining us from Driehaus. He's a portfolio manager, always has a nice assortment of ways to look at this market through the charts. Yoav, great to have you here on the show. I wanted to start with the broad overall market situation. In your mind right now, what's the easiest way to just explain the consistency of this market run?
Yeah, well, look, certainly the stimulus, both monetary and federal stimulus that we've had has done a lot in order of supporting markets. So certainly that's a key part of it. The other part is, there's the FOMO trade. Everyone's concerned about missing out on the bounce back. We had a trajectory that people were playing for in terms of a recovery, whether it be a quick V or a little bit longer. But that's definitely been the undertow of what's been driving the markets higher here. Okay,
so what about this big wall of money that was parked when all the bears were running the show in March, Yoav? Because I've looked at all these sentiment or investor positioning, the Bank of America flows. One of them that I know you pulled from this fund manager survey as well is the shift from major bearish exposure on the hedge funds to now like chasing the market. Is there still more of this money left to chase from the institutional side?
Yeah, I think the money flows and sentiment are key at pivotal points. Once sentiment gets too extreme, then obviously you're susceptible to either a snapback or a reversal. And obviously what we saw culminating there in late March was not only that sentiment had become excessively bearish, but also then you had the Fed step in with stimulus. And we've seen people bring money back in. Now, that hasn't been uniform across all asset classes or all markets. Certainly, there's still a lot of money that's in money markets. But between hedge fund exposure or just general market participants stepping back in, cash balances coming down, we've seen that unwind. So certainly that's something that goes into consideration when you think of not only the massive drawdown that we had, but the seemingly as an impressive bounce back we've had from the lows.
How much, with what degree of accuracy, Yoav, can we say whether or not Wall Street as kind of this monolithic entity is short or long at any moment? I mean, do we really know? Is it kind of a triangulation that's more Bermuda style than anything?
Yeah, I think that's an interesting and probably an appropriate characterization. I mean, it's difficult to know exactly where all the end markets and all the positioning tie into overall sentiment, but certainly I think you can use situations such as these, particularly in manager surveys or just in general sentiment indicators, for really the extreme situations when you really can sense sentiment across multiple asset classes, which is something we saw in mid to late March. We saw capitulation not only in cash balances, but also in fund flows for investment grade and high yield credit, outsized moves. I think when you put everything together, you can get a mosaic or a better picture, but it is sometimes difficult, particularly in the derivatives market or in the options market, to get a sense of what the end exposure is, given there's a lot of offsetting and a lot of hedging, et cetera.
So first, we know the retail traders got really bullish near the bottom, and then Wall Street basically followed. That was a much covered story. Right now, in conclusion here, what would you say is Wall Street now very bullish stocks? Would we consider the overall market to be getting one-sided yet to any degree?
To us, it seems like it's a little bit more balanced. We've certainly come away from either extreme, but nonetheless, if you look at it from a fundamental or valuation standpoint, we're fully valued, likely a little bit stretched. There's a lot of expectations for next year. Now, we don't really know what's going to happen here in the next few weeks, as we've seen in the past few weeks, and certainly predicting how the path is going to unfold next year is certainly an uncertain undertaking. So, I think with where we are today, people need to be a little bit more cautious in their approach, kind of a more measured approach in terms of investing, understanding that valuations, particularly equity valuations, and even if you look at where credit yields are, spreads are still not at their tight, particularly in high yield, but the all-in yield that one is getting compensated for is certainly at the lower end historically. A lot of that's driven just by the base rate in treasuries, but you're still getting compensated through an all-in yield, which you need to take into consideration.
Okay, Yoav, I want to keep going here. Also, I'm sure a big part of the market strength has just been that kind of Fed model style dividend versus 10-year yield, earnings yield versus 10-year yield. Obviously, we're at some pretty clear levels that favor stocks over the bond yield. What does this mean? I mean, does it mean that any change in the Treasury direction is going to be problematic for equities? Does it just mean that there's really no alternative out there right now?
Well, if you look at the equity markets from an earnings growth or GDP or even revenue growth, it doesn't look super rosy for this year. Next year is obviously a different story. But when you look at equity valuation in comparison to both yields and Fed stimulus, those are probably the two strongest arguments for why equity markets can continue to rally or why investors are playing for that. When you have the Fed laying down the framework of what they have, where they basically said they'll do anything and won't stop at any measure to support the markets or the economy, if you will. And then you also realize that in terms of a yield play, there's really no alternative. Back to that whole Tina framing. Then people will participate in the equity markets. I think what's been interesting this time around is obviously the chart that you have up shows the disparity between Treasury and S&P yield, but also what we're seeing right now is that a lot of dividend stocks actually haven't been working. Utilities have gotten some attention for not working, but what would be dubbed quote unquote dividend stocks have underperformed what their macro model would show or lead to believe in terms of this type of low yield environment. So that's something that's a little bit interesting and different than say 3-4 years ago.
Interesting. So while from the macro perspective, this offers an explanation, the value for equity yield over the 10-year on a stock and kind of sector specific basis, maybe it doesn't hold up quite as well. I mean, we've talked about this too here a little bit. The utility financial relative strength has withered some. We haven't really gotten a big utility rally. Part of that goes into the value conversation to some extent, where value is trying to make a fight here, Yoav, but just still can't really turn around as a factor overall. Is it ever going to happen? I mean, if it doesn't happen in this recovery from COVID, will it ever? Does it look like this could be the time?
Well, it certainly hasn't been up till now, and I think part of that, is what people have been paying up for, and that's been growth and momentum, and people want to see revenue growth, EPS growth, however you may dub it, if you will. We don't really sit there and make calls on whether value is going to become back in vogue or not. But I think when you look at a chart like that, again, that's just showing you some of the extreme nature undertows of the market. And similarly, when you look at large caps versus small caps, I mean, a lot of what the S&P and particularly the NASDAQ has been driven by a few select large cap tech names, a lot of companies with strong balance sheets, positive cash balances. And then when you look at small caps in relation, they haven't had, broadly nearly the same recovery. They're still well off the lows, but certainly the Russell has lagged. So there's, those are the companies that are probably more affected by the industries that are suffering at the hands of COVID, as well as the credit cycle and the need for credit. So underneath the hood in terms of the market, I think you start seeing some more bifurcations that are more telling of the overall story.
How much is the value story a market cap story, Yoav? The Russell getting just trounced by the NASDAQ on the past year. Today, again, the Russell takes a little bit of a nosedive, just really having trouble moving past some of the moving averages, having trouble breaking out. Should we link value to small caps, given the pummeling that the big caps have been putting on?
We've been looking at small caps more from the industry concentration and makeup, and I think there's still plenty of opportunity. Obviously, there's quite a lot of uncertainty still remaining. Everyone's acknowledged that, but if we do have a trajectory where we recover, if we do have a situation where the economy is able to open up and start on the path toward some sort of normalcy, then plenty of industries, whether it's financials, whether it's industries that are severely impacted right now, lodging, gaming, airlines, et cetera. There'll be lots of opportunity, particularly in the small cap space. I think it's been notable to see that the small cap volatility has remained elevated relative to large caps. And in part, that's because small caps are a little bit more over-indexed to some of these industries that are more affected, as well as the need for credit, which is an important part of funding, whether it's in equity markets or whether that's in the credit markets for these smaller cap companies.
So basically, the small cap situation, relative to big caps, the value relative to growth. One of the other charts you've got is energy versus the S&P 500, another part of the small cap space too for some of the smaller shale players and such. Yoav, all these look like they're at potential points that are somewhat unsustainable in their historical context. The value chart, even next to other recessions, looks like if we come out of the recession, it's poised to turn around. At least Buffett thinks maybe time is here to get an energy play going. If the stars do kind of align for reopening, is this the trade in the market? I mean, is it, if you had some special insight in a hypothetical here that the worst of COVID is over, Texas will get its stuff under control, yada, yada. If that's the case, do you just pile into energy value and small caps?
Well, certainly we would not be piling it into energy, and part of that is just related to the fact that you're at the whims of the commodity, and it's very difficult in our estimation to predict where the commodity is going to go. So, if that's the largest input in the revenue driver for an entire industry and we can't get comfort in it or appropriately discount the risk associated with it, then, that's for us kind of a stay away from. But acknowledging that on a valuation basis or performance basis, obviously energy's had a very difficult time. Some of that's certainly warranted. Some of that has to do with supply and demand. But, again, looking at a chart like this, I think is worthy to highlight just how massive the moves have been, both, since this century began, both on the upside and on the downside. And it's kind of indicative of the boom bust cycle of that industry.
It's definitely been busting from this chart. Yoav, before we let you go, I want to make sure, I want to hit one more with you. If we come back around to the overall market, this one's from JP Morgan, from your latest write-up here. And I like this chart too. That's basically looking at correlations. Now we know that during the heat of the crisis, correlations basically went to 1. And the JP Morgan chart looks at long-term correlations though, like a year. So should we expect then for this to reverse and asset classes to break apart a little bit? Is that typically what happens when you come out of a crisis?
Yeah, certainly that would be, the playbook. Obviously, we're somewhat in unprecedented or uncharted waters. But once you have all asset classes move in similar direction and magnitude, correlation spike, there's a period of outsized moves. I mean, what we witnessed in March and April, even just the daily moves in the market were significant. We've started to come back down from that. Obviously, we're seeing the VIX come down. A lot of the other uncertainty measures or the volatility measures across the market have come down. Notably the MOVE index, interest rate volatility has become suppressed due to the Fed stimulus and actions. But certainly, I think we'll see is as people get more comfortable, as this becomes more normal, daily moves become smaller, we'll see correlations come down, the opportunity for dispersion increase. I think this morning I was looking at some stuff and saw some charts showing that we've actually now, from a 1-month implied S&P standpoint, we've reached the correlation levels back down to what we saw before the massive spike occurred. So as time goes by, as wounds somewhat heal, I think people and investors will get a little bit more comfort, and we'll continue to see correlations come down from these extreme levels.
Okay. And for those watching looking at the chart there, the PMI is flipped on its head. So the big spike in red you see is the negative PMIs that we got. All right. So potentially some big moves here if we ever do get to that turning point on some of these charts. You all have a good job characterizing this market. Appreciate you joining us as always. Thanks a lot.
Thanks a lot.
You got it. Yoav Sharon joining us from Driehaus.